Hey there. Thanks for joining us at this week's episode of the Apartment Academy, the multifamily industry's only operations-focused podcast and your institute for higher NOI. I'm your host, the Dean of the Apartment Academy, Daniel Cunningham, and today's guest lecturer is Eric Sussman, who's the founding partner at Clear Capital. Interesting enough, Eric is also an adjunct professor of real estate and accounting at the Anderson School at UCLA. So he really is a professor, really teaching at an institute of higher learning. So Eric's perspective is a little broader today than the operations side we often focus on. And we're going to talk a little about the market, what's happening right now in multifamily, what the trends are, and ultimately where are there opportunities in a market right now, this being October 2022 with interest rates on the rise. I thought it was a fascinating discussion. I wish that we could create 3 or 4 other episodes with Eric because I think there was just a lot to unpack in today's real estate market. So without further ado, here is Eric Sussman. Well, welcome to the Academy, Professor Sussman, a term in which case here I use non-ironically because you actually, when you duck into the phone booth and put your cape on, you turn into super professor at UCLA's Anderson School of Business, right? So you wear a lot of hats. We're going to ask you to wear your real estate hat today, but your experience is going to allow us to delve into some other subjects. So really pleased to have you on the show. Give us just a little bit, Eric, about your background from PricewaterhouseCoopers days to now. What's your journey been like?
Oh wow, that's a long area of discussion. But you said it pretty well, Daniel. I guess broadly speaking, I live in sort of 2 worlds. I'm the managing partner of a real estate private equity firm, Clear Capital. We do value-add multifamily acquisition and repositioning, and there are lots of others in the space that do that kind of magic. I'd like to think we do it better, but we do it well. And then I'm a longtime faculty member at UCLA's Anderson School of Management. To my knowledge, I'm the only professor in the country with appointments in accounting and real estate. I actually joined the faculty as an accounting professor. You mentioned PricewaterhouseCoopers. So one of my passions and interests is actually forensic accounting and fraud, of all things. I'm one of the somehow experts in the country in that area, and then I lived in the real estate world. So you're going to get both perspectives today, so buckle up.
I'm not sure I thought I'd ever hear the phrase, one of my passions is forensic accounting.
Hey, I know. Usually that involves intoxicants and the rest of it. But I don't know why. I always joke, Daniel, that if I hadn't been a professor type in real estate, I would have been some kind of detective. I think unsolved murders, those various TV shows, Forensic Files, are some of my favorites. So there you go.
Right on. Well, we post the transcripts of this show. And we may rate very highly SEO for forensic accounting as a result. So Clear Capital let's just clarify the audience a little more. So no ground up construction. You're acquiring assets, repositioning.
Exactly, that's well said. I mean, we do basically, as I said, value add repositioning. We're buying Class C to B product and maybe turning to B plus, maybe A minus on a generous curve. We don't do any ground up construction because my obsessive compulsive disorder and inability to control everything from neighbors to city council people precludes me from getting into that market. But I certainly respect and appreciate those that are willing to do it. But we just focus on existing stock.
And a long hold period or a shorter pro forma?
Yeah, that's the question we get asked all the time. It's changed, obviously, as the market shifts. I used to say that our hold period was maybe 3 to 5 years by the time we execute our plan and do the magic of increasing rents and the rest of it. I think that's changed for a number of reasons, some driven by the markets and other factors. But so now I say it's 5 to 7 years. But every asset is different, and look, some investors want out as soon as possible, get their hit, and others like to holding cash flow, existing assets. So try to give the investors what they're looking for as best we can.
Yeah, I can imagine these days investors are looking for a little more safety than they were a few years ago or a few months ago. Yeah.
You know, investors are fickle creatures. I say all the time, and the analogy that I use, we could talk for quite a bit about that too. Investors are funny, and the analogy that I use is if we've all been to Vegas, and I don't know what everyone's poison is. I happen to be a craps player, and you think about the craps table, how it can turn from a very lonely, quiet, sort of site to a, everyone's screaming and people are throwing bets on the worst bets of all possibilities, the hard 12 or something like that, or snake eyes. And it's fascinating how that happens. The markets are the same way. Investments are the same way, from euphoria to depression. It doesn't take that long, frankly. And so we're definitely seeing some change in the market today, obviously.
Well, I like that analogy a lot. So, folks have been putting the money on the hard 12 for the last 6 years, and probably couldn't go wrong. They were hitting their point. But markets are shifting now. So let's talk a little bit about, if you would, Eric, about what's happening in the real estate market right now, what that's being driven by, interest rates, et cetera, investor perception of safety, all that sort of stuff. So what's it like out there right now?
It's definitely changed. I mean, obviously, I'll focus on the multifamily market. You said you want to talk about office or industrial or other market segments. We certainly can, depending on our time. The way I describe it now, Daniel, is I think people are in a state of what I call price discovery, which sounds pretty wonkish and academic, but I think it's accurate. I think to a certain extent, sellers are still living in the good old days with a little nostalgia, wishing that they could still sell their assets for, the 3 and 4 caps. Meantime, buyers are out there thinking they want distress and they want some great bargains as a result of some of the dislocation out there and higher interest rates. Both are too early to the party, frankly. So what you're seeing now is just far fewer transactions, not a lot of inventory or product for sale on the market, and I think a lot of even listings that are just not actually being consummated in terms of transactions. I think, again, because sellers are still maybe a little bit just living in the illusory past, and buyers are hoping for this, great future of bargain hunting. And I think, let's say, both are a little bit off in their timing.
Is there a strong corollary between a rise in interest rates and a rise in cap rates? Is it one for one, immediate, or is there some delay?
Yeah, it's first of all, I mean, Gabe, that's one thing we all have to sort of appreciate, and as an academic, it's sort of a wonk. The data with real estate is always by definition lagging. We don't have real-time data. People ask me all the time, hey, Professor Sussman, what's happening in the real estate market? And I'm like, well, what market are you talking about? Are you talking about, single family in Austin? Are you talking industrial product in Phoenix or whatever? So to answer your question really with specificity is really tough because we don't have the data. But here's the way I think you can think about it, Daniel, is look, we've had this unprecedented, really remarkable rise in interest rates, certainly on a relative basis. Nothing like it in history in terms of the rate rises we've had from, of course, a very low base, but just an extraordinary rise. So that happens immediate, right? That's a quick, immediate hit to sort of the denominator, if you will, the discount rate or sort of cap rates, whereas the rents or the numerator lag, right? Rents are going higher, but it's just lagging as leases roll and as you rent out units. So, by definition, it has to be immediate. I mean, just if you're thinking about the efficiency of markets, but it just doesn't work out that way because, again, the way real estate transactions are the transactions don't even close immediately, right? Even the most quickly executed real estate acquisition, maybe 45 days if you're lucky, but more like probably 60 to 75 days. So there's a problem you have right there too, Daniel. Just the timing creates challenges in terms of answering your question. But theoretically, academically, the denominator happens right away. That's as interest rates go up, you should have that immediate expansion in cap rates, and the opposite's true. But the numerator sort of stays the same, at least in the very short run, and you do your renovation magic, at least the way our firm does it. So that's how I think about it.
Even given maybe cap rates that are sluggish to evolve, the impact to in terms of lenders and the kinds of loans that acquirers can secure is more immediate. What's happened in that market, Eric?
Obviously, look, uncertainty is never good for markets. It's not good for investors. It's not good for capital providers. No one likes it. And we're in this, period of tremendous uncertainty. So in some cases, lenders have just pulled out of the market. I mean, the biggest growth in the lending market in our world has been the debt funds, sort of people call it the shadow banking industry, which sounds so nefarious. But if you think about the traditional lenders to the real estate market, good old Fannie and Freddie, my favorite couple in the world. They've got a really nifty printing press, and their cost of capital is as low as anybody's. But what's happened actually over the last, I'd say, 5 to 10 years is the growth in real estate funds, Cerberus, even Starwood, Lument, Centerbridge. These sort of funds you may have not heard of, but they do a lot of sort of shorter term bridge financing to folks like us, value add players. And that market has just, again, the data isn't available because they're non-regulated or essentially non-regulated. So that's where I think you've really got sort of a lot happening. I would love to have visibility into their books because they've got a lot of floating rate debt and some assets are probably underwater right now. In fact, no question about it. Meantime, other lenders are just increasing their spreads for the uncertainty, and obviously, as you've got increases in both the Treasury rates and SOFR, the LIBOR replacement, you don't need a professor to tell you those were a lot higher in the last year. So you've kind of got it from a lot of different angles, which is they're not positive, obviously, for the market, obviously.
And has there been? I don't know that there's a. I don't know, and you would if there's a metric or who's tracking the acquisition velocity right now. But has there been a chilling effect that we can note already on acquisitions?
Yeah, you get again. It's much harder in the commercial world. I include even multifamily in that sort of sphere. We get better and more timely data in single family, obviously, and single family transaction volume is way down. But I'm telling you, anecdotally, it's way down in multifamily. But that data lags because you can appreciate there's no real way of measuring that data in real time. Data aggregators like CoStar, Reese, or whoever sort of people use out there. Again, Torto Wheaton research, it lags, and they're scrambling to get data as best they can. But it's again, there's no central point of sort of market information where we have it. But I'm telling you, and everyone would acknowledge, the transactions are down substantially.
So even in a market like this, deals can get done if buyers are willing to transact at a higher cap rate, et cetera. But there's another, I think, fuzzy bit of the crystal ball at this point, which is what are your pro formas are going to look like? What are you going to anticipate is going to happen to the market? Even if you can acquire an asset at a fair price, do you project growth at this point in rents? Do you?
Yeah,
what's a massive recession do to us?
Yeah, a lot of things go through my mind. It's one thing I tell my students. I always ask them this question. I say, what's the one thing that's absolutely unequivocally true about every spreadsheet projection ever created? They're wrong, obviously. I assume Cleo, the Jamaican psychic, that she would have been great to have as an analyst. But
we're dating both of us. With Cleo.
Yeah, she wasn't Jamaican or a psychic. It was shocking to learn this little data point. But no, you're absolutely right. Look, I've always required students, and even in our office, that we do sensitivity analysis. That is, you look at the 3 key variables driving any model, and in real estate, of course, exit cap rate, your projections on rental growth, and that sort of thing. You sensitize them. But the heart of your question goes to just how difficult is it to sort of forecast variables in such an uncertain marketplace. So what do you project? I think you have to sort of step back, and it's hard sometimes. It's just look at the real estate, look at the dirt, look at the location. Do you like the asset? Putting aside everything else, and then you sort of have to sort of think about your model and projections and so many variables that might go into your model, which could be again a local sort of analysis on what the market looks like and whatnot. But you're absolutely right. Look, if you're putting together a model and you're thinking about, of course, what is the exit cap rate market going to look like in 3 to 5 years, or what is rental growth going to look like, where we've got rental drops, declines. There's no question in recession rents decline. They just do. We can debate on how much. But I would say this too, Daniel. That's why, to me, I think it's really important that you don't lose too much in the individual cells of a model, and you step back because we've been through this. We've been to this prom before. I mean, we've been through crises. I've been through half a dozen of them in my career as my hair thins and my forehead grows. I'll go through more of them. And so, from my standpoint, you have to step back and say, look, what's happened historically? You've had rent drops and maybe cap rate expansion, but the fundamentals over time have dwarfed so those short-term moves. And we still have housing affordability issues. Apartments are the future. Higher density housing, multi-generational, housing situation is going to persist. And those are real big tailwinds to the market. So that's how I sort of, not to get too sucked up in the short term, but recognizing, of course, it makes modeling and pro formas more difficult.
Well, you touched on something else where you have some expertise that might be interesting to talk a little bit, which is in spite of everything we just said about the uncertainty in the market and perhaps the difficulty right now in getting some deals done, I want to ask you, first of all, what that effect has on new construction, because, and then we want to talk about, there is ostensibly a housing shortage in this country. So, when you have a housing shortage, you maybe think of a more price resilient kind of market then. But first of all, will the threat of a recession, will rising cap rates, will all that put an end, and the difficulty with lenders, does all that really bring new construction to a standstill?
Yeah, I won't say standstill because there's always this lag, but of course, I mean that's the issue. Look, we've got to think about sort of the more systemic and structural supply issues in the real estate market, and then with the shorter term or sort of trends that are happening given the rise in rates. Both are relevant. But if you look at the data on housing starts, they're down. And they're down substantially. It's not surprising. The higher cost of borrowing, shortage of labor, lack of available land, NIMBYism, of course, all these sort of things that are sort of affecting supply, both short-term and long-term. But look, in the short run, you've had this extraordinary shift in the yield curve and interest rates, which create problems for contractors and developers to make deals pencil. So you've seen that in the data already, a decline in permits that are being issued. So the starts data, again, it is lag. You have the starts, which things are already out of the ground and happening. So those are going to be built. They've gotten their commitments. But if you look at the permits, so the number of permits that have been granted over the last couple of months, those have fallen off substantially. So that speaks to however long you sort of think in the future we'll have fewer product coming out of the ground and a shortage in supply, again, exacerbated in maybe the next year or two. And look, on top of that, if you talk about single family, we've never reached the peak of 2004 and 5, even in the recent upcycle. So we've never built enough housing. Apartments have sort of maybe been built to sort of make up for some of that shortage, but just not enough, and it's generally Class A product, so it's kind of problematic.
And you talked about NIMBYism also affecting public policy. So in the midst of a housing shortage, in the midst of now becoming more difficult to build, there are also things happening on the public side that are also exacerbating the problem. Are there areas to be concerned about, Eric, or trends to be concerned about on that front if you're thinking about investing in real estate?
Yeah, there's so many things to concern yourselves with. Look, I can think about a couple things. Let's talk about just NIMBYism generally, right? Not in my backyard. I don't know if you've heard of Banana, which is build absolutely nothing near anything near anyone, which is now replacing NIMBYism. But that is a real issue. Yeah, it's incredible. But I'll just tell you one anecdote about that, because I want to the way I want to answer this question is sort of think local and then talk about government and public policy. So there's a great anecdote out of Atherton, California. I don't know if you know where Atherton is. It's a hop, step, and a jump away from Stanford. It's an enclave. I think the median home price is something like $8 to $10 million. So we're talking high rent district. Anyways, they wanted to build 58 apartment units in Atherton. And Mark Andreessen, if you know that name, he was the founder of Netscape and a very well-heeled venture capitalist. He and his wife wrote letters to the city council protesting these 58 units because of the typical stuff, right? It's going to affect this and that. And my favorite was, it may affect their home values. This is like a billionaire, okay, who's writing a letter complaining about 58 units in their neighborhood because of their effect on home values. Okay, give me blanking break. Okay, I mean, this is the problem, and I could tell you lots of those anecdotes. So you have that at the local level. Meantime, of course, politicians who are supposed to be formulating housing policy are getting so much pressure from every side about the lack of affordability of housing, right? There was a great story in the New York Times we were talking about earlier a couple of weeks ago in Kansas City, Missouri. And I don't think people think of Missouri as a hotbed for renter uprising, where I think the median home price in Kansas City is like 235,000 or something. And here the city council meeting was interrupted by a bunch of protesters saying the rent is too damn high, the rent is too damn high. That was their chant. And so think about that. That's Missouri. In Florida, which actually is had statewide abandoned or voted against rent control in the 70s. In Orlando, on the ballot next week is a measure to bring rent control back to Orlando in good old Florida. So look, I don't care where you are in the country, whether you're in California, Oregon, and we think of these bright blue states, or you're in Missouri, Florida, Colorado has some issues. Rent control is coming. Politicians are going to have to deal with these pressures of housing affordability and their constituents complaining. And as I said, everyone's a socialist when it involves their own pocketbook. So that's a real issue I think we all need to be sort of mindful of as you're thinking about the multifamily markets.
And I just want to give you the opportunity to say it, because I know it's in somewhere deep inside that you want to say this. Has rent control ever served to provide a better housing stock or
No.
Has it ever worked anywhere?
Well, this is the issue, right? I mean, economists, may not agree on much, and there's this old joke about economists that you should, cut off every economist's left hand so they can't say on the other hand. But the one thing economists pretty much agree on is rent control, and look, price controls generally, you think about tariffs or whatever, they don't work. They do not work. They're palatable, and they're sort of easy on the brain maybe for a lot of folks who think about affordability issues, but they just don't work. And I've written a lot about this for a whole host of reasons many of us can probably appreciate. Rent control doesn't work. I will just broaden that out to say that, look, economic sticks generally versus economic carrots, they don't work. And I'm a true believer in economic carrots, things like Section 8 or, where we can do some other things as opposed to economic sticks, which are just a lazy and ineffective public policy.
I'm glad to hear you say that. I'm relieved that your students there at UCLA are getting the right sort of education on this subject. Let's boy, we could keep going on and on about this. Let's wrap up with your insights into, given all of this, where is there opportunity right now in this? And by the way, given we should probably date, this is October 31st, this is Halloween 2022. So, this is as smart as either of us are at this moment in time. But given that, where is there opportunity right now? How can you make money in real estate in times like this?
Yeah, look, there's always opportunity, and the only thing is, as Wayne Gretzky said, is it's about where the puck is going, not where it has been. So I tell my students, look, maybe because I talk about my own career. Look, I started my career in real estate, 30 years ago, doing infill projects and value-add projects in Los Angeles, Echo Park, Silver Lake, Hollywood, these gentrifying areas. And we did fantastically well, and that game is basically over. I tell my students in candor, you can't do what we did. But what's happened? So what are the big trends? I think that's the key. To answer your question, you have to sort of look what's trending. And look, housing affordability is an issue. The migration from the coast is an issue. Look, that's why if you look at California, from Boise, Idaho down all the way into Phoenix and even parts of Texas, have grown so much. On the East Coast, it was all the growth into Charlotte, Nashville, Atlanta, et cetera. So people have left the coast. So that is a trend that is going to continue, in my opinion, as people look for more affordable housing, better schools, and just to be able to save some money. There was another article I read in the Wall Street Journal this week on a couple moving out of California to St. Louis, I think it was, back to Missouri. So to me, I think the future is going to be in markets that have been sort of maybe not your, not your markets that that would make you very excited. I mean, if I said, "Hey, we're looking at Cleveland, Cincinnati, Detroit, Columbus," in Detroit, you tell me, "Eric, have you been inhaling some of that cannabis, California's herb, or what?" And I would say, "No." I'm thinking very clearly that I'm not saying Clear Capital is going to those markets, but I wouldn't be shocked, Daniel, if 10 years from now we look at the markets that have really grown over, let's say, between 22 and 26 or something, and it was some of these really class B to C markets, tertiary, quaternary markets, suburbs of suburbs, because that's where people are going to go to afford to live, and we'll see how that plays out. But that's my sense.
Thank you for that, Eric. Is there? We failed to ask this at the onset of the show. Is this Clear Capital raise funds? Is it all? Is it? Do you secure your funds from, insurance companies, that sort of thing, or can anybody listening? Is it possible for them to reach out and say, "Hi, I'd love to invest alongside Eric"?
Well, my gosh, thank you for that that softball, Daniel. It's the World Series, so I'm going to tee up and hit it. Well, look, I mean, obviously, we do raise money from accredited investors through Clear Capital. We're really syndicators at this point, which we have one-off offerings. So we have done funds, blind pools before, but the one thing I would encourage people to do, because at the core, I'm a professor and educator, and I wear multiple hats, but I do write a very lengthy quarterly newsletter. I just released our third quarter newsletter. It's available on LinkedIn or our website, no obligation. You can sign up, at least see what I'm thinking of. It's 20 to 30 pages. I don't think Warren Buffett is shaking in his shoes about my letter, but I think your listeners may find it worth reading, get some nuggets in there that are worth reading, and if they're interested, of course, you can sign up for our various offerings and that kind of thing. We do have one joint venture partner, but it's really mostly just accredited offerings to investors like your listeners, I imagine.
Wonderful. We'll put a link to the newsletter and the LinkedIn in the show notes so people can get to that easily.
Oh, I appreciate that.
Thank you so much for coming on today. Hate to cut us off, short, but it feels short. But we really shared a lot of great information, and we will hold a show in maybe 6 months, and we'll see. We'll go back and revisit your predictions, and we'll see what's right, what's wrong.
It's my pleasure to be here anytime. Yeah, cutting it short. Remember, you're talking to a professor, so I get going at a half an hour. This is no problem. So my courses are 3 hours long. So no, anytime, Daniel, happy to be a part of it.
Thanks so much.
Okay.
Take care. Thank you for joining us at this week's episode of the Apartment Academy podcast. The Apartment Academy is a production of Leonardo 24/7, the industry's leader in multifamily operations and maintenance software. At Apartment Academy, we realize the hard work that goes into property management and the stress that comes along with it. Leonardo 24/7 takes the guesswork out of your team's day-to-day by providing customized daily guidance on tasks that need to be done, guaranteeing consistent operations across your entire portfolio. To learn more, visit www.leonardo247.com today.